Orient Cement has reported a 21% decline in its March quarter profits, while the total income has dropped by about 4%. What were the key factors weighing on the company in the last quarter, and what does the road ahead for the company look like? Let's ask the Managing Director and Chief Executive Officer Deepak Khetrapal. Thank you for joining us, sir. Wanted to understand what is weighing on the EBITDA margins, and could the pressure on margins continue going forward as well, given the way petcoke prices have moved?
Well, just to get the numbers right and get the perspectives right, I don't think we've suffered a decline in EBITDA margins over last year's same quarter. In fact, there's a marginal improvement at the EBITDA level. Performance is slightly better. Now, what is looking worse is the net profit level, where obviously it's the tax provisions that we've made. When you turn profit, last year we had losses, and this year we've turned back into profits. So obviously the taxation has hit us, and that's why the PAT level looks like it has eroded, but not at the EBITDA or the operating profit level at all. So that's just one part of the thing. The overall, I think, results, if we look at for the company in this quarter, we've actually done around 84% of capacity utilization, which I think is something that we can take a lot of satisfaction from. And the momentum in demand and the momentum in price actually that we are seeing going on from early April, that actually augurs quite well for the new financial year that we are now into. And we are looking forward to building a good year based on the demand momentum, one, and number two, the improvement in prices that we've seen in the recent few weeks.
Fair. So could you tell us a little more about what's happening on the demand front, and when can we see the pace of volume growth pick up?
If you notice the volume growth that is being reported by the industry, it's obviously fairly robust. The only reason why our company has not reported volume growth only in Q4, rest of the year we've been reporting volume growth throughout the year. Q4, the only reason is because we are comparing it with the fourth quarter last year, in which we really had an outlier quarter when we utilized capacity of 87%. So obviously with 87% capacity utilization, there is not too much room for growth left for you. And but just clarifying, is the momentum in the demand in the market strong enough? Yes. Why did we not report last quarter growth over the previous year? Is purely because we had 87% utilization already. So that's the clarification for the industry and for the company.
Sir, the realizations were down on a sequential basis. Is there a possibility of further deceleration when it comes to realizations?
No, on the contrary, after prices remaining very soft in the fourth quarter, what we've actually seen is price improvement from early April. So as we speak, we seem to be back on track how we were in the first half of last financial year, which was much stronger. I mean, just to sort of clarify the picture, while the year as a whole we've closed at EBITDA per ton of nearly 560 rupees, if we look at purely the first half, our EBITDA per ton was close to 800 rupees. So the prices that we are seeing now are comparable to prices that we were seeing in the market last year, April. And that actually should improve our EBITDA per ton as we work now and go forward, assuming that the prices that have improved, they stay in the market.
All right, and if you can also talk to us about capacity utilization, which is at current levels, and also the acquisition of JP Associates assets has increased your capacity into what extent, sir?
Well, JP acquisition has not got fulfilled yet. We have a transaction. In fact, we are now awaiting the final confirmation that all the conditions precedent to the transaction are being met by the vendors. We still haven't got their confirmation. So those capacities are still not with us. That's one clarification. There is a long stop date to the transaction, which is actually end of May. So in the next few weeks, we'll have complete clarity on by when are we likely to get the conditions fulfilled by the vendors, and only then we can get into the business. But in terms of capacity utilization, as I said earlier, in the quarter that has ended 31st March, we had capacity utilization of around 84%. For the year as a whole, we are in the 73-74% in that range. And currently, as we speak, this quarter also, I mean, although it's still less than 5 weeks, but we are seeing positive signs in terms of demand and our growth over last year same time. So it's too early to talk about the quarter as a whole. But yes, first 4 or 5 weeks, we seem to be definitely way ahead of last year.
Are we likely to see some sort of a moderation in debt levels going forward?
Obviously, when we say moderation in debt levels, one thing we have to understand is that the borrowing that we have on our books, which largely came for our new project that we commissioned about 2 years ago. On that, yes, a repayment program has started. But in the meantime, what we've done is, because we've had profits in this last financial year, and obviously if we look at the last year with the total EBITDA being at 325 crores, and interest outflow of, let's say, about 130 crores, we obviously have close to 200 crores of the cash generation, which we have actually parked, obviously, some of the borrowings that we were making for working capital earlier, that we've not utilized. And as a result of that, if you take note, our overall financing costs in this year is lower than the previous year. So what we are right now doing is, although cash is accruing, but the capex that we are continuing with, we are not borrowing any more money, we are using our internal cash flows, and also not utilizing our working capital facilities. So cash accrual from the profitability is helping our overall treasury, and that's why the financing cost is looking better than it did last year.
So just want to understand a little more about the South Indian market and where the demand for cement is actually coming from. Is it more from the affordable housing front or some of the metro projects of the state governments, or what? What are the demand supply dynamics right now, and where are these? Where could possibly the volume growth come from?
The volume growth, let's be honest, right now is largely coming from the push on the government-sponsored, government-funded projects. Road projects, we've all known about how much work is going on across the country. Plus, there are various pockets in the country, especially around our areas of operation, which include Andhra, Telangana, Karnataka, and Maharashtra. Irrigation projects, the affordable housing projects, the smart cities. So a lot of these projects are on, which are consuming a lot of cement. But we also are seeing a steady demand from the housing segment in the semi-urban and rural areas of the country. While in the urban clusters, obviously the demand for cement is not much, because hardly any construction activity is there because of the overhang of inventory there. But in terms of semi-urban markets, rural market, independent house builders, and the government-sponsored projects are the main sources of demand that we're meeting today.